Hello and welcome to the Sound Financial Group podcast. My name is Paul Adams, and I am joined today, as usual, by a man who is so sharp. Lawn darts play with him. Corey, I'm glad that you could be here.
I hope you woke up in the middle of the night last night like, I got it. That's what I should say.
Totally stole that joke. It was a gut-felt introduction I saw in a video clip, and I was like, that one actually applies to Corey. So I thought I would go ahead and use it. Now, today, I'm psyched to be able to share this with all of you because we're going to give away basically our protection philosophy today. How much and how to own the insurances that you need. We're going to do our best to make it a very tight episode. But first, just thinking a little bit, Corey, why should people care about making sure their insurances are accurate for where they are now?
Well, insurance, we insure something when the loss would be so catastrophic that we need to offload some of that risk onto someone else. That's why people talk about self-insuring, and you really can't. That's not a thing you can do. You just either get insurance or you take the risk yourself. Like
self-insurance, fake news. Not true, not real, fake news.
Like you might decide that the risk is small enough that you
take the risk.
Don't want to get the insurance. A lot of people are doing that in Florida right now, where premiums for home insurance are getting really high. Now, I don't agree with that choice for most of the cases, but that's the assessment that they're making. So getting your insurance accurate, like if a thing is so valuable, it would be catastrophic to lose it. We want to make sure we have as much of it protected as possible and in the right ways so that in this random world, our world is random and our country is litigious. So those two things are a lot of things that we don't control that could have an impact on our future success and our balance sheet. So if we can wipe as much as possible all the things off of our balance sheet that we can control as having an impact, then what we're left with is just our choices as much as possible dictating where our balance sheet goes in the future. And that's a much stronger place to be. So that's why it's important.
Yep. And well said. And since here I was slamming self-insurance. So if you're somebody who thinks you're self-insuring right now, I'd encourage you. And Miranda, if you wouldn't mind, throw this in the show notes. It's episode 247, self-insurance, 249. Self-insurance is a scam. I would encourage you guys to take a look at that if you have been saying you're self-insuring something because you're just taking the risk. So today we're going to cover, Corey, car insurance, homeowners insurance, umbrella policy, disability insurance, life insurance. We won't get to wills and trusts today. But as we go through that, y'all, I want you to think about what are the misconceptions that you've heard that perhaps we're going to clear up today when we talk about these insurances. Just drop it in the comments below. One, we want to know what misconceptions you guys are facing out there. Two, if there's anything specifically we did not hit on in this episode, we'll just do another episode and you'll have another post that addresses the question that you have. So,
or if you don't know if it's a misconception or not, if it's just a thing you heard or the last thing you were taught about one of these and we didn't specifically talk about it, put that in the comments below. We'll have some fun later going through those.
Indeed. And because I can't resist, be sure that you like this video and that you subscribe. And if you would, Miranda, have them put that subscribe little ding in and it'll go right along with this wink. Okay, so that's how we do our editing over here. We just let you guys know what we're editing and hope to God that went ping. By the way, put in the comments if they didn't do some kind of cool sound effect with that. I want to know. All right, let's start with car insurance, Corey. Everybody insures their car. They're driving around the road with a ton of randoms every day. What are there are different sections. We have your liability. We have your uninsured motorist liability. deductible, etc. Why don't we just start with deductible? That's going to be the first term everybody's familiar with.
Well, and one thing I'll add, not everyone insures their car. Like, it is the law that you have to have auto insurance, I think, in every state in the country. And most people have auto insurance, but they have the liability section, but sometimes they don't have their car insured. If it's like, grew up in Maine, it was like the beater in the field, the old truck, 30 years old, runs every Tuesday, but not most of the rest of the week. Like, it wouldn't be that catastrophic of a loss if it was. So it just doesn't make sense to pay premium on replacing the car, but the liability protection is there. So that's just one more good example of, if a thing is valuable enough that we don't want to lose it, we insure it. And if it's not that catastrophic to lose it, we don't. Now, on the deductible side, so deductible, higher the deductible, the lower our premium, the lower the deductible, the higher our premium. So lower deductible means the insurance company kicks in sooner. So we've got to pay more for that feature. Now, I see a lot of folks, Paul, I think you've probably seen it too, north of 50% of everybody we meet has a deductible similar to what their car insurance was the first car they got in college or out of college.
Now, or the first time they got off their parents or whatever. Yeah.
Or they got their parents, right? So that $100, $500 deductible, I mean, that might have been tough to meet with the amount of cash in the checking account back then. Even it was good to have that deductible there, because you wouldn't be able to get over it if it was any higher. But now we see folks with 20 times that in their checking account, just day-to-day slush fund, and we say, hey, you could save some money on those premiums. So if you can handle it, we usually see $1,000 as a sweet spot of that deductible.
So when they set your insurance premiums, there are all these components they figure in. So you picture it like a Venn diagram overlapping. There's like your zip code, the kind of car you drive, your credit report, driving record, and your deductible. And every now and then, if you are at a $500 deductible and you go to $1,000, they're going to tell you it saves you like 97 cents a year. Right. If that's the case, don't change it. But do stay on top of it, because those pricing things can change later. So that's why $1,000 deductible. The other reason for $1,000 deductible is, imagine that you're just backing up. You're at Costco. You hit a pole. Nobody is hurt. The pole is not damaged. The only thing is there's $1,000 of damage to your back of your car. And if you're one of those people that makes what I think is the rational choice of, do I report it to my insurance company or not? Just about everybody says, I wouldn't report it because I don't want my rates to go up. So if you would have $1,000 claim that you wouldn't report to protect your premiums, then don't have less than $1,000 deductible.
And a $500 deductible is paying more for something that you're not actually using.
Yes.
It's like having 2 gym memberships and going to neither.
Going to neither. So next up is liability protection. Liability protection is how well you are protecting everyone else from you. So if you get in a car accident, what's a very common liability number is 100-300. So if you see that on your car insurance, what that means, it's 100,000 per person in the other vehicle or vehicles, 300,000 maximum. So if there are 4 people with a very legitimate claim for $100,000 each, then passengers 1 through 3 get $100,000 and passenger 4 gets your contact information. That's what we don't want. Now, the most common deductibles that we recommend are 100-300 or 250-500.
Coverage levels. Yeah.
Yes. But hold on to that, because we're going to explain why those levels in just a couple minutes when we get to umbrella policy. Now, up next is your uninsured motorist. General rule here, you should protect yourself and your family to at least the level you're protecting everybody else from you.
From you, right?
Yeah. So your uninsured motorist is just designed to act like someone else's car insurance if they don't have any insurance or they don't have enough insurance. And why that's so important, it was right after the financial crisis. So like early 2009, one of the big polls that came out was something like 25% of the people in Southern California were driving without car insurance for a window of time because people were so tight on their budgets. So Really important, uninsured motorist. 2 coverages to consider dropping. Do not do this until you've contacted a professional or you've worked with a financial coach that's helping you with this. But there is car rental coverage. It's not catastrophic. We can recover from paying for a car rental. Number 2, many families don't even need a car rental anymore because we have enough cars, people work from home, etc. And last but not least, you're always going to see a max. It might be $35 a day, maximum $400. It's like, if I can afford a $400 thing, I don't need to insure against it. It's right up there with getting a Best Buy warranty. I missed one, Corey. Oh, our MedPay.
Medical, yeah.
I'll hit this one real quick, then I'm going to have you take homeowners because I need to breathe. So in the medical, there's something called personal injury protection. When you go into the doctor, they give you a form, and one of the questions is always, was this a result of a car accident? And the reason they ask is that doctor's office, no offense to the doctor's office, but they would rather submit their claim to Allstate than to Blue Cross Blue Shield. If they send it to Allstate, they get fully reimbursed. If they send it to Blue Cross Blue Shield, they get whatever their reimbursement rates are. So we are literally, we help ourselves with our deductible maybe if we got in a car accident and needed to pay our medical bills, but we have that deductible for a reason. I might get in the hospital because I fell down my stairs and broke my ankle. That would be the kind of thing that could happen to me that nobody else is going to pay for. So I selected my deductible based upon something I could take. And that medical insurance coverage that's on that form isn't even well priced most of the time. These are small coverages they're able to tack on, significantly increase profitability of the insurance companies. Corey, did I miss anything on car before we go to you?
No, I will say that if you've got a teenage driver in the house, all of these may be thrown for a loop. So, especially when we get to the umbrella side. So, just again, this is a starting point for you to hear some things and start a conversation with someone specific. Don't just run and act on every single thing here without understanding the whole picture. Okay, homeowners insurance. Now, we're going to make a similar observation around deductibles with homeowners insurance with an and then some. So we see low deductibles on homeowners insurance, and we often encourage folks to get quotes to look at what those would be at $1,000 or more level on their home. And the reason, besides saving money, is promoting good long-term decision-making around whether or not to make a claim on our home. Now, in our auto insurance, if we make a claim, our premium might go up. And the claim stays with us. It doesn't stay with our car. Like, we can sell the car and someone else can get auto insurance on that car based on whatever their situation is. Homeowners insurance claims stay with that home. And if you get too many claims within too short amount of time, like I think it's 3 and 5 years.
More than 2 and 5 years, most companies will begin consequential action.
Then your property can get on a blacklist, essentially. It can only qualify for the state insurance fund, the fire insurance fund, it's sometimes called, that is the highest cost and least comprehensive kind of insurance. This is why a good friend of mine, Dan Dela Cruz, an excellent State Farm agent here in Illinois, told me, any of his clients that have rental properties, another reason why they all need to be in their own ownership and their own separate policy, other than just your own liability against your rentals, is if they're all in the same zip code and one hailstorm comes through and they're all in the same policy, 3 claims on 3 houses in 1 month, like you're right there in one storm.
And looking like a risk.
Looking like a risk. And then, but if they're each in their own policy, it's a lot easier. So the last part of that is if it's your primary home, if you're going to sell it, most folks are coming in buying with a mortgage and they've got to have proof of insurance before that mortgage closes. They're going to find out if you've made too many claims and gotten your home on the blacklist, if you will. It could be much harder to sell that home. Replacement coverage is another one. There's 2 different kinds of coverages for the belongings in your home. One is current value and one is replacement value. We want replacement value because if your house burns down, you're not going to go find a refrigerator the same age and model as your current one. You're just going to go buy a new fridge. Now, as part of that, if you have replacement value coverage, amazing. How are you going to prove to the insurance company what was there to replace? They want some sort of substantiation for that. So
I've right before we do this, something important I think should be put down in the comments. Let's say your house burned down. You've got replacement coverage, so you have to replace everything. I've always thought about you go out and buy everything, but I think I could set a record of the amount of Amazon boxes that would be on my front step to replace everything in my house.
Oh my God.
Just one, and like one cart too. So it all shows up as quickly as possible together. If anybody else thinks massively replacing everything in your house from Amazon would be at least an interesting social media post of the boxes, comment below. Okay, cool. Go ahead.
Like, could I order so much that UPS just sends a truck?
Yes, that's what I want.
It's just for me.
Yeah.
The driver gets out like, hello, Mr. Shepherd. Good to see you.
Or they screw up the logistics and it's like 90 trucks throughout the day. That's the one I would prefer.
Would you really? I'm pretty sure you wanted me to park in your driveway blocking it so that Amazon couldn't drive their trucks.
Oh, I just don't like them driving through on like the oval that is my driveway.
Okay.
So I like them having to back out. Like I want to hear the backup beeper every time an Amazon truck comes. It's a thing I have.
Love it. So replacement value, really easy way to solve for that. If you have kids in that, 7 to 12-year-old range, especially, good way for them to earn their dinner tonight. Hand them a phone, or if they have a video camera, just take your iPhone, walk through the house with a quick narration of what's in there. It doesn't have to be super intricate, but just get that video.
Yeah, just open everything. Closets, open cupboards, because that will be what you need should there ever be a complete loss claim. And you're going to see your policy also gives you the ability to like live somewhere else for a year while they rebuild your home. You're paying for the replacement coverage, but if you don't currently have it inventoried, you don't quite have the coverage.
Yep. Let's see. I think that's great. Oh, now liability limits inside of home insurance is important as well. We often see those. At higher levels in auto. The joke that we make to folks is like, if you hit someone right around the corner from your house, maybe pull them back and lean them up against the garage and say the garage door did it. Now, I'm not advocating insurance fraud. That's just a joke. Not that it's that funny. But the idea was that you have, this much higher coverage at home where you're generally more safe and only people that know you are coming over versus driving out in the world with the randomness and the potential crazy.
Yeah, the chuckleheads. So one last thing on the car insurance or homeowners, since we talked about it on the car, is you're going to notice if you're looking at your declarations page, there is something called MedPay on your home.
Yeah.
They give it away with homeowners insurance. That's how unlikely terrible things are to happen to us in our home. They literally give us MedPay at no cost on homeowners insurance. So you ready to shift gears to umbrella?
Umbrella. Yes.
Okay. So it's a good place to pick up because we just talked about the liability levels on the car and the liabilities level on the home. And the simple example would be if your car is 100, 300 and the house is 300, you hit the person in the crosswalk, you're covered for 100,000. How do we fix that? Ideally, in most cases, people have their car and homeowners insurance with the same company because there's usually discounts. Well, it's also required most of the time if we want to get a personal umbrella policy is that the company issuing an umbrella policy, just like it sounds, it's an umbrella that's covering over the car and homeowners insurance, giving you additional coverage, picking up where either the car or the home leave off. They call that your underlying coverage. That underlying coverage, the insurance company will tell you what it needs to be. So some companies, your car needs to be 250, 500, and your home needs to be 500.
Most. I would say that's more common than not is 250, 500.
And then some allow a 100, 300. Yep.
Yeah.
And so if we have that 100, 300 or 250, 500 coverage, you'll find out if it's sufficient when you call to get the umbrella policy. Now, we have the umbrella policy for two reasons. One is of course, that if it was our fault and it's really a problem, we want an umbrella policy that is at least 2.5 times our income or 10% more than our net worth. So 2.5 times our income or 10% more than our net worth. Now, the reason is we want it to be more attractive to go after than us personally. And believe it or not, it helps in several ways. One is, imagine you get in an accident and your coverage for the one other person you hit is 100,000, but they have a legitimate case against you for over $1 million. They think they proved some kind of negligence. Well, if that insurance company has got to defend that, they're not supposed to do this, but human nature is normal. And they're going to look and go, well, we're definitely losing our $100,000 on this one. Let's send that new kid that just passed the bar exam. He can go defend this one.
Try it out. Right? Richie should try this one. Yeah.
Yeah. But if you've got them on the hook for $2 million and you get sued for $1.5 million, they're sending the A-team. They're sending their best attorneys to defend that case because now they know they can negotiate it down below their limits. Now, believe it or not, you also have the potential to have the plaintiff's attorney. If we have any plaintiff's attorneys listening, please comment below. I want to hear what you have to say about this. But you will create the plaintiff's attorney in some ways being your ally. They become your ally because think about what it takes to go after you. If they're going to come after you so hard that in many states, your income can be attached for up to 25 years in the case of a lawsuit where you didn't have enough insurance. They may be able to force you to sell your home depending on your state's homestead laws. They may be able to go after your investment accounts. That's a lot of work for that plaintiff's attorney to pursue all of that. They would much rather do the thing that the insurance company does easily. They will literally give a separate check all up front for that settlement to the attorney and to the client. And that attorney would rather have their 30% today than to have to work over the next 5 or 10 years to try to get it from you. So we're protecting your future income and we're protecting all of the assets you've built up until now. Get an umbrella policy. If you're driving home from work today, call your agent before you drive home.
Call your agent. Yeah.
Yeah. If you're driving right now.
Say, folks ask us how much umbrella to get, and we have our formula. The joke, if we're feeling funny, is like, just tell me how much you're going to get sued for, and I'll let you know how much umbrella to get. Right? That's the real answer. And so when you go to get that quote, umbrella is ridiculously inexpensive as far as coverages go.
Oh, yeah.
Again, maybe not if you have a teenage driver in the house, but if, say, that formula that we just mentioned is $1 million for you, well, also ask for $1 million more. Like, wherever you come down on the formula, just also ask for a quote for an additional $1 million on top of that, because often you will be so surprised on how little extra it adds to get that extra $1 million that you say, I just as soon have that extra $1 million. Like, you could ask them, how much the max that you'd let me have? And depending on your situation and everything that's going on in your world, it's good to know, because you may want that. You may want that extra peace of mind. You get to make that decision.
And one other thing I'll throw out here is, you know how we say on the podcast all the time, Corey, that you should not listen to somebody just because they threw out an opinion on a YouTube video or on a podcast or on the radio, or you read an article. Except this one. Get an umbrella policy. Do it before you drive home today. It won't hurt you. Okay. Disability insurance?
Disability insurance.
So here's I'll give one high level thought about it, and then I'll let you handle the specifics of individual and group stuff. The easy thing to think about with disability insurance, everybody thinks of somebody being in a wheelchair. We think that the person that's in a wheelchair somewhere, because that's what our handicap signs say. Except that is not most disabilities. That is the minority of disabilities. Most of them are things you can't even see that end up putting somebody out of work. So we like to say, if you're unable to work due to sickness or injury, it's a much better interpretation. And if you want to know how your income might be affected, here would be my challenge. Everybody listening at some point has had the flu. Now, as you're listening, I don't want you to think, about what would make you feel like you have the flu. Just imagine you feel just like the flu, but for 2 years. And what would happen to your income capacity? Now, there's many people out there that might be listening, go, well, if I was in a wheelchair, after I got through my rehab, everything else, I'd be just fine because I sit at a desk all day.
Right.
Maybe. But what if you felt like you had the flu for 2 years? I've had the flu.
That fog, that just kind of nothing is as easy as it used to be. Yeah.
Not being able to get too far away from facilities or whatever. Whatever would cause that is what we need to address against. And if your income shuts off, you not only lose your future income earning possibilities, except many times I've done the math with people in their early 40s, being out of work for like 2 years could wipe out the last decade of the work you've done trying to build up your net worth. Like the formula really does work like that. So Corey, maybe jump into a little bit about group, individual, how much to have.
So most people listening to this call will already have some sort of disability insurance, because if you work for a large employer, that's one of the benefits that has come pretty standard these days. And it's often something like 60% of your salary up to a cap, often $5,000 a month. If you're a doctor working at a hospital, that monthly cap is usually higher. It's usually something like $10,000. So the first question you've got to ask is, am I actually getting 60% of my income covered by that group coverage? Because that cap could keep you lower than that. If you're making 200, go ahead, Paul.
I was going to say, and those group programs rarely ever cover bonuses.
Well, that's the other
commissions.
Part.
Yeah.
Right. So they have to be really clear on the language that they use. Is it just your base salary? Is it your total average monthly income? That'll work out better for you if you're getting bonuses every month or every quarter. So that's one thing you've got to think about. What's the actual rate that I'm covered at? And then take taxes off the top, because your employer, unless you are paying for the disability with after-tax dollars, it is going to be taxable to you as a benefit. Like because your employer is getting a deduction on their taxes for the employee expense, so that every dollar that flows through your paycheck in some way is going to get taxed somewhere along the line. So if it's a pre-tax deduction, it's going to be a taxable benefit. So take 25-30% off the top of that to see where you're covered. So that's 60% of your income group disability policy could only be 20 or 30% of your total all-in income after tax.
And if, as you heard that from Corey, if your stomach just shrunk up a little bit, like, oh, I didn't know that, that's a good reason to, reach out to your advisor, or if you don't have one that has these kind of conversations, reach out to us. And we're going to go into a series where we're going to talk about disability and life insurance. So throw your questions below. Things you'd like to hear us talk about as we get into deeper specifics rather than the overarching conversation we're having today.
Now, there's more that we're not going to touch on right now about language in the contract. We're just talking about amounts of insurance. There's a whole deep dive on specifications inside of disability insurance. But if you are somewhere less than 70% of your total income covered by your group policy, you may want to consider going onto the private market to add supplemental coverage on top of that to get you up to that max. And that's about the highest that you can get, somewhere between 60 and 70% of your income covered in disability insurance. No company wants you to have more than that, because then if you were disabled, you would have no reason to get better, even if you could.
Indeed.
They want some. And so there is a max that you can reach, but most folks are pretty well started by their group policy, but would benefit from some additional amount on top of that to help make up the difference.
And for some of you may be listening and be like, I don't know how I would ever get disabled, et cetera. Well, of course, after you like and subscribe and comment, go to the description. And what you're going to see is a link to an episode that I did years ago with an actual client of ours. It's episode 111. Miranda's going to put it in the show notes for everybody down in the description. Big deal, though. He was kidnapped. 2 captors kidnapped him. They had kidnapped a friend of his earlier, and that was part of how they got him in the car. And he ultimately ended up killing both of his kidnappers. And that whole experience permanently disabled him. And in the interview I did with him, he literally said, I never, ever thought in 1,000 years I would get disabled from anything other than hanging Christmas lights. And it will blow up all your preconceived notions. Again, it's episode 111. If you're listening to the podcast, you can find it really easy. It's called The Worst Case Scenario. And we'll have a link to it down in the description of this episode on YouTube. Oh, after that light note, Corey, why don't you jump into life insurance?
Now, life insurance is more, folks come to us with life insurance questions much more often. It's much more top of mind because of that polarizing finality of I'm alive or I'm not. The reality is disability insurance
finality. I love that, Corey.
Yeah, disability insurance is much more likely to impact our lives. Like there was a stat from a few years ago. I haven't seen it updated recently, so I don't know if it's 100% true anymore. I think it's more true. 1 in 3 who are working today will experience a longer than 3-month interruption of their working life before they retire.
Yep.
And so more than 3 months or less, that's short-term disability. 90 days or more, that's the world of long-term disability. So so that's worth looking into. Now, life insurance is also very important because they're the same math. It's how would our family live without our income stream? Now, disability, you're not earning money and you're still around to be expensive. So that's another thing to think about. In the life insurance side, it's how would your family do if they knew, they were never getting your income ever again. So outside,
I was going to say a major misconception people have is like, oh, well, if I'm disabled, all the bills are the same. But if I die, half the bills are gone. I challenge you. We don't need to convince you. Right. Go look at your own balance sheet right now. Do you have just tons of money sitting in the master closet you forgot to invest because there's so much of it? No. Even the money you don't spend, you're actually setting aside for the future to make sure that you and your family are okay. Would your surviving spouse not need to make sure they had money set aside? Look at the budget. I challenge anybody listening to this that if either spouse died, that the total spending could possibly drop more than 20%. And that's for the people that have the country club memberships the wife can't wait to cancel or the husband can't wait to cancel as soon as the other one dies. Right. Super important. You got to replace a lot of you in the case of you passing away. At least with disability insurance, somebody could get better. But at least according to my faith, one guy got out of the dying part. So everybody else is going to die once. It's pretty final.
So the first place I worked in this industry, I had a worksheet to go through a conversation with folks around what they ought to think about for life insurance. And the first question was, well, how much do you think a funeral would cost? And it made logical sense to me now from just like a spreadsheeting kind of component. But now I think about it as the most ludicrous way to start talking about life insurance. And it was because a funeral, let's face it, is the smallest line item expense of someone passing away in their 20s, 30s, 40s, 50s.
Yeah.
It just is versus the income that is lost and the lost opportunity cost to the family. But then it was, how much do you think your kids might need for college, or what other expenses do you want to pay? And number one, the client's not trained to know that. I'm supposed to be trained to help with that. So it was very clearly and this is what a lot of financial institutions do, sales techniques to let a largely uneducated sales force get up to speed selling something as quickly as possible. That's what that is. So now we flip that all around. It's ridiculous to ask what costs you might have or might need. Like, no one's going to know what life is going to be like until they get to that point. But we do know the value, the net present value of that future income stream based on what someone was earning and how old they were at that time. And that's a economic term that life insurance companies use called human life value. It's impossible, a person as a mother, father, husband, wife, son, and daughter, priceless. An insurable number, that's called human life value. In your 20s, it's 30 times your income. In your 30s, it's 20 times your income. In your 40s, it's 15. In your 50s, it's 10. And in your 60s and beyond, it's 1 times your net worth. Now, as you can see, the insurance company is saying, how old are you? How many years left approximately do you have till retirement? And how much are you going to earn between now and then? And coming up with some kind of number to replace that value. If losing something would be catastrophic, we want to replace as much of it as we can. And in your 20s is actually the only time that mathematically you can,
right,
with life insurance.
Because speaking of which, y'all, if you're a regular listener to the show, you'll have listened to our episode where we talked about how much do you need to retire and talking about the 4% distribution rule. Well, it's no different. If you're in your 40s right now and you make $300,000 a year and you'd like to replace that for your family, you need 25 times your income to replace that for your family so that a 4% distribution can handle it. And Miranda, if you don't mind, let's put that in the show notes too. So down in the description below, right after you like, and then you go to that comment. And then you can get the episode. But you need that 4%. But once you're in your 40s, you can only get 15 times. So your assets make up the remainder. So you don't need to subtract out your assets from the 15 times. In all likelihood, you probably don't have 10 times your income in assets right now, especially given that your spouse can't produce any income from home equity. Also, paying off your mortgage is still just a 4% decision, even in a 7% environment.
Right. So based on your age and your income, that's gonna tell us a starting point to go investigate what it would take to get the right amount of insurance for you. Now, those are always starting points with insurance companies. If there's a good reason, they'll enter into a negotiation around a higher or lower amount than that. But just like an auto insurance company won't let you insure your 10-year-old Toyota Camry for $200,000 replacement value, they won't give you any old amount of life insurance because they don't want spouses doing math when they fight.
I love that one, Corey.
Like the old movie where the plot is the wife knocks off the husband for the insurance money. Well, those screenwriters really didn't understand how the life insurance works. Like Paul and I joke, like our wives know we are worth much more alive than with the significant amounts of life insurance that we have.
Yeah, so all you have to do is have your spouse listen to that episode on the right amount to retire. They'll get the distribution rate and understand it a little better. Now's a good time because we need to wrap this up, Corey. We just did a hard sprint through all of these.
Yeah.
But here's what we'd like to do. Not only are we going to maybe go deeper into the points of disability insurance, but we also get a lot of questions about life insurance. So we're going to cover the different types of life insurance. If you want a certain type of life insurance covered before other types of life insurance, get that in the comments below. If you see somebody else's comment that already says the thing you wanted, you can go ahead and like it or post it again. Either way is fine. We'll count it all up. Because what we're doing, we're not doing this podcast because Corey and I like talking to each other. I mean, we do like talking to each other. Yeah, I mean, Corey tells me he likes talking to me. I don't know for sure, but I like talking to Corey. But we do it for all of you. And it's our sincere hope that anytime you see something, put it in like, hey, I saw your episode a while ago. I changed this. If you're listening now and you change some stuff in your life as a result of listening, just put it in this episode. You can say, hey, that episode back 23, put the link in there, share it with somebody else, because I can tell you that especially this conversation around insurance, unless you've got enough money that you're like family office services kind of level, your typical financial advisor doesn't even cover the simplicities of car insurance, despite the fact the very advisor's accounts they manage will get liquidated in a lawsuit. And we want to help all of you be able to protect whatever you've built, even if you're not a client of ours, because we see too much malpractice happening out there in the marketplace.
Absolutely.
Corey, anything else you want to send everybody off with?
Thanks for hanging in to that sprint. Like, I'm sweating underneath this jacket. It was cold today, but I don't need it anymore.
Corey, give him a logo flash before we go. So I know it looks a little inappropriate. There he is. There's the Sound Financial Group logo. I didn't wear mine today. Maybe I'll wear it next time. Tune in to join us then. In the meanwhile, we hope this episode has been a contribution to you being able to both design and live a good life. See you next week.